Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. Today, we're digging deep into the latest research on E2E Networks Limited. And this isn't just, a standard look at a tech company. The report we're using, the final comprehensive analysis, paints a picture of some serious strategic ambition. We're really looking at a company trying to dominate one of the most capital-intensive sectors out there, AI infrastructure.
That's really the heart of it. E2E Networks is an Indian cloud provider, sure, but their specialty, their big bet, is on GPU-accelerated infrastructure. That's the hardware that powers, well, pretty much all the AI and machine learning stuff we hear about every day.
So our mission today is to unpack that.
Exactly. We need to uncover this massive strategic push they're making and, maybe more importantly, the financial tension that comes with it. This is a multi-billion-dollar bet on the future, and we have to ask, can their financial structure actually handle the speed they're trying to move at?
Okay, so let's start with the macro view, the big picture. We know the Indian cloud market is growing, but E2E is focused on a very specific hyper-growth niche within that. What are the drivers we're seeing?
Well, the growth forecast here isn't just strong, it's almost parabolic. If you look at the projections for the Indian cloud GPU market specifically, it's expected to surge from about $80 million in 2023.
80 million, okay.
To over $1.3 billion by 2032.
Wow. That's an incredible trajectory. Yeah. We're talking a CAGR, a compound annual growth rate of, 36.5% for almost a decade.
Exactly. That's the kind of tailwind that companies just dream about. It creates this almost an insatiable demand environment.
And it's not just organic demand, right? The government is actively pouring fuel on this fire.
100%. The centerpiece here is what's called the IndiaAI mission. And this isn't just some policy paper. This is active procurement. The government is planning to buy over 32,000 GPUs.
And they're not just buying the hardware, they're subsidizing its use. Is that right?
That's the real game changer. For providers like E2E, this is huge. The government is offering these substantial subsidies that cut the effective hourly GPU rates for Indian users by a massive 40 to 60%.
40 to 60?
Yep, compared to the global cloud providers. So if you're a startup in India or a research lab, the economics make choosing a domestic provider like E2E a complete no-brainer.
So that subsidy just fundamentally reshapes the competitive landscape. What else reinforces that buy domestic advantage?
Two really crucial things. First is data localization policy. The Reserve Bank of India, in particular, has directives about financial services, data banking, insurance, BFSI data.
It has to stay in the country.
It has to physically reside on servers within India. That gives a huge structural advantage to domestic players like E2E who own that infrastructure. And second, you're just seeing this explosion in enterprise AI adoption. The broader Indian AI market is projected to grow at a 40% CAGR. So the demand is coming from big established companies, not just startups anymore.
Okay, so let's pivot to E2E itself. They want to be a leading domestic hyperscaler. But, you're going up against giants like AWS, Azure. You need more than just home field advantage. What's their actual fundamental moat?
The report really boils it down to three pillars. The first, and maybe the most obvious one, is cost leadership. They are offering high-end GPU services. We're talking H100s at rates that are up to 60% cheaper than the global players.
60%. That's not a small discount. For any AI company doing heavy model training, that's months of extra R&D budget right there.
It's a massive difference. And your next question is probably, okay, it's cheap, but is it any good?
Exactly. Is their tech stack a differentiator?
It absolutely is. And that's the second advantage. It's their proprietary software, the Seal AMO platform. This isn't just some off-the-shelf billing portal. It's built from the ground up to optimize how resources are used for these really complex AI workloads.
Which creates stickiness.
Total stickiness. Yeah. Once an enterprise integrates their whole workflow with that platform, the cost and hassle of switching to a different provider, even a big global one, just goes way up.
And the third pillar has to be about the hardware itself. Getting your hands on these chips is half the battle.
It's almost the whole battle right now. And that's their NVIDIA partnership. In a world where the top-end GPUs, the H100s, H200s, and the new Blackwell chips, are so supply-constrained, being an elite partner is a huge barrier to entry for anyone else. It means E2E gets preferential allocation. They can get the hardware and build out capacity faster than their competitors.
And we're seeing signs that the strategy is working, right? Specifically in their geographic diversification.
It's a huge strategic pivot that seems to be paying off. The report shows the revenue mix just shifting dramatically. Revenue from outside India. It was only about, what, 8.9% in fiscal year 24?
Just a sliver.
A year later, fiscal 25, that number surged to 33.7% of total revenue. That tells you their cost advantage and their tech are portable. They can compete on the world stage, which is huge for de-risking the business.
Okay, now let's connect this back to capital. A push like this costs an enormous amount of money, which brings us to their partnership with Larsen and Toubro, or L&T. What did that deal do for them?
The L&T partnership was brilliant. It solved two massive problems at once. First, obviously, the capital. It provided that huge cash injection they desperately needed to fund this aggressive GPU build-out. We'll see that in the financials. But second, and just as important, it gives E2E a golden ticket to L&T's huge enterprise client base.
Ah, so it's a sales channel.
It's a ready-made pipeline. Management wants more stable, high-volume contracts from big companies, and L&T just opens that door for them.
All right, now for the main event. This is the core tension of the whole story, the financial paradox. The report lays out this picture of explosive growth right alongside some pretty severe financial stress. What's the headline diagnosis here?
The headline is that E2E is running a venture capital, high-burn strategy, but they're doing it inside a publicly traded company. They are consciously trading today's financial health for a shot at tomorrow's market dominance. So you see strong accounting profits, but you also see a, frankly, terrifying cash flow crisis because they're burning money way faster than they're making it.
Let's start with the good news then, the top line strength. I'm looking at the income statement analysis, and revenue growth accelerated to an incredible 73.57% in fiscal 25.
Operationally, they are a machine, and the margins confirm it. That breakup of margins table, it shows gross margin just kept expanding, hitting 81.4% in 25.
81%. So for every dollar of revenue, they're keeping 81 cents before overhead. That's incredibly efficient.
It is, which makes the next part so jarring.
Right. If the core business is that profitable, why are we even using the phrase cash flow crisis?
Because of the cost of chasing that 36% market growth. This is the cash flow crisis section. Despite those great accounting profits, the company generated deeply negative free cash flow. In fiscal 25, FCF was negative. Get this, 92,679 lakhs.
Let's just pause on that number. A lakh is 100,000 rupees, so we're talking about an enormous cash burn. It's almost 10 times worse than the year before.
And that deficit is a direct result of one thing, CapEx, capital expenditure. They are spending hand over fist to buy thousands of these GPUs and build out the data centers. It is 100% by design.
But they knew this was coming. The balance sheet was engineered to absorb this exact shock, wasn't it?
It was. That capital raise in fiscal 25 completely de-risked the company from an insolvency perspective. Look at the balance sheet engineering. The debt-to-equity ratio, it just plummeted from a very risky 1.45 in 24.
Meaning they were heavily leveraged.
Very. And it dropped to 0.07 in 25. They basically paid off all their debt overnight. And liquidity improved too. Their current ratio went from a pretty stressed 0.7 up to a healthy 1.7.
That sounds great for stability. But there's no free lunch. Where did the other shoe drop? What was the cost of all that new capital?
It showed up immediately in the return metrics. This is the distortion I was talking about. That new capital caused return on equity, ROE, to just collapse.
Yeah.
It went from 36.8% in 24.
A great number.
Fantastic number. Down to just 5.7% in 25. And return on capital employed, ROCE, also fell off a cliff, down to 4.8%.
Hold on. They sacrificed over 80% of their return metrics? On paper, that just looks awful. How could a business be that efficient on one hand and have returns that low on the other?
This is where you have to understand a line item on the balance sheet called CWI, Capital Work in Progress. Think of CWI as a massive, brand new factory. It's fully paid for, it's sitting there, but it hasn't produced a single product yet. All those new GPUs and servers, they sit on the balance sheet as CWI.
So they add to the denominator of the ROE calculation the total capital today.
Exactly. But they aren't generating any revenue yet. So the math just crushes the return metric. It's a painful but very deliberate trade-off. Management is saying, we will accept terrible returns today for the capacity we need to win the market tomorrow.
Beyond that CWAP distortion, the report did flag a couple of other, maybe more traditional warning signs about earnings quality.
It did. The first is the reliance on other income. In fiscal 25, this other income, which is basically just interest they're earning on the cash from the fundraise sitting in the bank, made up 62.8% of their profit before tax.
Whoa. So most of their pre-tax profit wasn't from selling cloud services.
It was from interest income. And that's not sustainable. As they spend that cash on GPUs, that income is going to disappear.
Yeah.
Core operations have to scale up fast to fill that hole.
And the second warning sign was about how quickly they're collecting cash from customers.
Exactly. We look at a metric called Days Sales Outstanding, or DSO. It tracks how long it takes to get paid after you make a sale. Their DSO jumped from a super lean 6.2 days to 13.9 days in 1 year. At the same time, their allowance for bad debt actually went down.
So they're getting paid slower, but they're less worried about not getting paid at all.
Right. That combination can be a yellow flag for aggressive revenue recognition, something you have to watch very closely.
Okay, so let's connect all these financial dots back to the central operational risk for the company going forward.
The single biggest risk is execution risk on that massive CapEx in C2buy. The number is just staggering. Capital work in progress hit 63,618 lakhs in fiscal 25.
That CWIP number is the entire story right now. If they can't hit their utilization targets, what are they aiming for, 80 or 90%? The fixed cost structure would just be brutal.
Devastating. The depreciation on all that hardware is a fixed cost you can't avoid. It's already 36% of their revenue. If that new capacity sits idle, that cost just eats away at your profits and destroys the great gross margin we saw earlier.
So, assuming they do execute, what are the catalysts that will turn all that CWIP into profit?
Well, the revenue visibility is actually quite strong. They have secured orders from that IndiaAI mission totaling 265 crores. That's real contracted revenue just waiting for the new capacity to come online.
So that's money in the bank, essentially.
It is, and their expansion plans are designed to meet that demand. They're talking about deploying thousands of new GPUs, maybe hitting 10,000 or more in the next couple of years. We're talking the absolute latest hardware, like the Blackwell chips.
And the L&T partnership is the sales engine designed to fill up the rest of that capacity with large enterprise clients.
That's the plan. So the concluding thought here is pretty clear. This is a make-or-break moment. It's a high-risk, high-reward profile. They've raised the money, they're buying the gear. Now, everything hinges on converting that massive pile of CWIP into revenue-generating assets as quickly and efficiently as possible.
So to wrap up the core takeaway here, E2E is a specialized hyperscaler with real, compelling advantages in cost and tech. They are perfectly positioned in a hypergrowth market. But that ambition has forced them into this critical period of burning cash and posting really depressed returns. For anyone watching this company, you have to keep your eyes on two things: capacity utilization and when free cash flow turns positive. And that brings us to our final thought. To secure the capital for this huge strategic bet, the company's founders had to dilute their ownership pretty significantly, from almost 60% down to around 40%. So here's the question for you to think about. In a sector like AI infrastructure that requires the sheer scale of constant investment, at what point does management's ability to raise that critical funding become more important than the risk of diluting their own control over the company's vision? It's that fundamental trade-off between control and capability.
Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time.
Welcome to